A special year-end coverage, and investment banks and brokerages embarked on a cost-cutting drive, we know, as revenues plummeted in 2011. Even large global outfits were forced to retrench staff to deal with the downturn. ET Now's Mohit Bhalla explains then why the year ahead could be even tougher for this industry and how only the fittest are likely to survive.
Generally, economic order is going to be at a lower level, and I think financial services are going to be more stressed than almost any other business that I can think of.
2011 hasn't turned out to be the best year for the financial services sector. Indian equities were the worst performers in Asia this year, and as foreign investors continue to take money out of India, trading volumes on the bourses plummeted, and so did business for investment banks and brokerages. The lull in M&A activity and the near absence of any major equity offerings made it even tougher for investment banks that were hoping to tap alternative revenue streams to sustain their businesses. Data from DealLogic shows that core investment banking revenues in India fell by 26% to $547 million this year, made worse by a steep drop in revenues from equity offerings, which fell by 75%.
Unfortunately, for the last year, barring one or two deals which I talked about, there has been virtually no equity capital market stream. The M&A stream was pretty good for the first half. Second half has not been good. But it is a cyclical industry.
The result? Most firms were forced to cut high-paid staff, and a series of layoffs followed, affecting some of the biggest firms. Nomura, Daiwa, Morgan Stanley and Credit Suisse are only some of the firms that have laid off people so far, and many more are likely to follow suit in the coming months.
Everybody in the financial services sector will have to seriously look at the cost of operations. I think the financial services sector over the last 5 years has really gone far ahead of the real sector in terms of the compensation, fixed compensation and variable compensation. And I think we have to learn to cut those costs and manage our costs much better.
Given the bleak outlook, experts believe that survival strategies for financial services firms in 2012 will have to be centered around flexibility and the ability to provide clients a broad basket of services.
Clients need a full service shop, and I think the way that the boutiques have set up businesses in India, their competitiveness is fairly limited. I think the way we built out our business in Jefferies in terms of being able to do bridge financing, in terms of being able to do high yield financing, M&A, equities, I think that's the kind of service set that clients are looking for.
Businesses that are broad-based within the financial services sector, I think, are better positioned to be able to face the challenges of 2012 than businesses that are very narrow. So you may be a dominant brokerage firm, but if the only business you do is brokerage, then I think you have a bigger challenge on hand than a broad-based institutions.
It's clear that the year ahead is going to be a tough one for the financial services industry, with layoffs likely to be the order of the day. Investment banks are already preparing themselves by making their teams leaner, their structures more efficient, and their businesses more broad-based. Only the best will survive. The rest will probably perish. Mohit Bhalla, ET Now, Mumbai.